All right, so it's the last day of the year. I'm around, so I decided, hey, let's do another market outlook video this week, just to kind of gauge what happened here this entire week. We did get that down day that we talked about on Tuesday, that we were anticipating on Tuesday. We got it on Wednesday, and then we were up and down until the close of today. So I'm going to break down the patterns that we've seen and some really interesting patterns that developed on some of the longer term, weekly, now monthly charts, going into the first quarter of next year, going into January of next year, going into the first week of January. So I'm going to break down what I expect the markets will do now going in for another year, and what kind of year we'll have. There's been a lot of chatter. It's funny how the consensus appears to be that we'll have a down year of 2023. That's what everybody says. But then everybody says that I'm going to go against consensus and expect that we'll have a really good year in 2023. And it's like, well, if everybody's going against the consensus, then isn't that the consensus? But I'm going to break down kind of what I think 2023 will be. And again, it'll be a big year for us market scholars. Again, this week is week number 250 that we've been teaching at Market Scholars. So again, we are doing a unique sale, kind of an anniversary holiday special, where we're giving our premium services a discounted rate down to $2,500. So it's a few $100s off of the regular rate, but it's $1,000 off of that regular rate will be on January 1st. The discounted rate, this coupon code will work through midnight of the 2nd. So you do have a few more days left to be able to use that if you've been considering using our services, like a lot of people have been. We really thank you very much for signing up. Or if you're renewing next year, you can renew at that discounted rate too before it bumps up on January 1st. So take advantage of that. I'll show you that where you can do that here later in the video. Let's go ahead and get started. Today is Friday, December the 30th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red button down below. Hit the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. You can see some of our premium resources here from people signing up using our holiday special code I told you about earlier. There's the coupon code for it here at the top, and click that button to get to the sign up page. Come down here at the bottom, click on this heart. We almost got 100 likes, so again, trying to get back up to that magic number there. That takes you to this page. Hit that like button. Click this thumbs up icon, takes you to this page. Hit that like button. Again, the more you do that, that goes a long way for us in helping us get our content out to all of our followers on those social media platforms. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So we ended up down on the day, though we did finish higher than where we opened. That's why we have an open candle here, but it's red. You can see we're kind of been really since December the 6th, since options expiration, we've been kind of up and down, and we finished there at 38.52. We finished the year at 38.39. So pretty tight range. Most of it below, this level where we ended up closing, and just a few times up above it. But you can see the near-term line followed the momentum line up into the reversal zone, just barely, but it got up above 80. You wouldn't expect it to stay up there for very long, as the momentum line's already dropping back out. Depends on how far down the momentum line gets. See, the near-term line did not follow the momentum line down there because we switched so quickly. We'll see what the momentum line does. The intermediate line is turning higher, but it's still in the lower reversal zone, so it's still below the 20th percentile there. And you can see we're trading right around that 2.5% mark, or below the 30-day moving average. Obviously, dark pink shading and a red line. All the indexes have the dark green shading and the red line here. As you can see, every single one of them. We are dark pink shading and a red line. The Dow is not. Here, give me 1 second. Here, let's try. There we go. So here, the Dow is a dark pink shading and a red line, as its intermediate line is in all the intermediate lines are in bearish territory, every single one of them, and all the near-term lines are all up into the overbought or over the upper reversal zone, overbought territory, except for the Dow. The Dow is just barely above 60, the near-term line, so kind of lagging behind in the strength of the last couple of days. The Russell had a lot of strength the last couple of days. In fact, it even finished, well, it was only down 1/4% here today. Everything down about 1/4%. The NASDAQ was down the least, only 1/10%, and it did, very well, though it had been more bearish going into this. Dark pink shading and a red line across the board for every single one of these. Let's take a look at the market forecast on, over here. Let's take a look at the market forecast on some of the other indexes, then we'll look at different time frames. So there's your NASDAQ, which got the cluster a couple of days ago. So there on the 28th, the NASDAQ actually got an oversold cluster. And then we bounced back up. So that was the day. So I did the market outlook on this day, on the 27th, because we anticipated, or I anticipated that we'd close down the next day, and I was on a road trip. In fact, it snowed so bad here in Utah that my 2.5-hour road trip turned into a 3.5-hour road trip in the snow. But on that day, we ended up getting the oversold cluster, and we have since bounced off of that. The near-term line going a lot higher than the momentum line, so that's why I don't read a whole lot into where the near-term line is going here, because it's not really a good sign for the near-term line to go higher than the momentum line. As you can see over here, eventually led to some weakness. That's the same thing you'd expect here. If you look at the Dow Jones, which has been the most bullish index, it's finally turned dark pink shading and a red line. Its near-term line is not up very much, and neither did the momentum line. So again, you would not expect the near-term line to go up too much further here because the momentum line didn't. Now it's a matter of which way the momentum line is going to go, because you can see it's kind of stuck here in the neutral range, so your near-term line will most likely stay stuck. I mean, it's a pretty tight range here. Again, since December expiration, we haven't really gone anywhere over this, but we've been below the moving average this whole time that we haven't been going anywhere. Finally, the Russell 2000, you can see has been pretty bearish too. Again, closer to the 52-week lows and other indexes. This momentum in near-term line got a little bit further up. The near-term line still oversold. This has been more bearish here, and it's still it's been a lot more volatile since December expiration, but it pretty much is flat since December expiration, like all the other indexes. All right, now let's take a look at SPX, and then let's look at the weekly chart. So we got these bear tags, 2 of these bear tags, right? And we're back below the 30-week moving average, though we haven't eclipsed that 2.5% mark for the S&P. The intermediate line is declining. The short-term sentiment is bearish. Market sentiment line is still declining as well. It never did really take off because we didn't go up very much on the intermediate line. It didn't even get into bullish territory. It got above the midpoint, and it's still at the midpoint, but did not get into bullish territory. And again, we're back below the moving average here. And again, this bear tag is either really, really bullish, or it starts, long-term bearish moves. And so far, it's not been really, really bullish. So you'd be leaning towards the other scenario. The NASDAQ never did get the bear tag. And so its only bear tag has been back here in August, and it's been bearish ever since. And you can see dark pink shading and a red line on the weekly chart, and just how bearish that is. The intermediate line dropping into bearish territory. Your Russell 2000, which you'll notice here, again, dark pink shading and a red line. The intermediate line has dropped back into bearish territory, bearish short-term sentiment. So you can see how, the markets are leaning to the downside pretty, on a long-term basis here. Now, one more look at the market forecast, but this time on the monthly chart, since we are finishing a month here. And the important thing to consider here is the bull tag that you got here, which, like the bear tag in the weekly chart, it either starts really good long-term bullish moves to the upside. Here, let me go back. I'll go back to 1957 when we started having 500 stocks in this index. So you can see when you get bull tags, they're either really bullish. So you can see you had one here in COVID. You kind of had one there in the fourth quarter of 2018, 15, 16. You kind of had one there in 2011. So you can see they can be really bullish, or they can start bearish trends. As you can see, both those bear markets started with bull tags. 2090, 1987, bull tags. that were really bullish. 1981, however, we started the bearish market. Again, not very long because of the low cape at the time. And then here's your bull tag in 1973-74 that led to a bear market. There's your bull tag in 69-70 that led to a bear market. So they're either really bullish or they start bearish trends. We've had 3 of those, 3 bull tags. This is the 3rd one in the past 7 months. It's kind of unprecedented. You don't typically have a cluster of bull tags. You had 2 in 81, 82. You had 2 in 77, which really wasn't a bear market there. By every other time you only had 1. So to have 3 in a matter of 7 months is really significant. Again, it kind of goes to show the failure to launch, right? Because all these other times we just launched immediately after the bull tag. We just launched, and we tried the month in July. We tried to bounce, get back up, but it failed in August. In August. And then we got another bull tag in September, so we tried to launch in October, and we actually went back up in November, but then this month we failed, and we failed with another bull tag. So now the question is whether or not January will be a bullish month like these other 2 and will fail, which I don't think we would. If we got a bullish month like either of these 2, then we would be up here above these lines, especially this long-term 23% line and this red 23% line, that we'd be back to being pretty bullish again. Tom Lee would be the hero of the day. But the reality is your near-term line's already up. It appears to be peaking. Your momentum line's already turned down. The momentum line you would expect will start to turn down, near-term line, to turn down with it. This is the lowest intermediate line, which is now out of bullish territory, mind you, which is it's not very common. Like over here, by the time it got out of bullish territory, we were already bouncing back up. We were already back to pretty much all-time highs or close to it by the time it got there. That was the last time we hit. Before that, it was a bear market, a bear market. In 87, we dipped down below bullish territory. But by the time we dipped below bullish territory, we got our bull tag, and we were up. It was actually this month here. We were bouncing back up. We had eclipsed these 2 months, and we were ready to go. We were raring to go by then. So not really a bear market. 81, 82, bear market. 77, 78, kind of quasi bear market. 73, 74, of course, bear market. 69, 70, bear market. So you can kind of see what's going on here. So this is the lowest. At 58, this is the lowest that we've had. By far, the lowest that we've had of an intermediate line, at the time of a bull tag on the monthly chart. And again, aside from a few exceptions, which were not bear markets, which were kind of one-offs, 1987, COVID, just deep, fast, quick corrections at that time. We are not in a deep, fast correction here. I mean, it's not like a 1-2 month drop. This has been a full year-long decline. Again, the expectation, we are below 2.5% here. The expectation is that we are most likely into a bear market, and this bull tag will not lead to a really good bounce to the upside. As much as a lot of people think are hoping that it will, more than likely it will lead to the beginnings of a bear market that we've seen in 74, in 2002, things like that. So very interesting patterns here on the market forecast going into 2023. Here's the NASDAQ 100. Its intermediate line's, it's already in bearish territory. So it's like, it's close, 40.2. I mean, again, for the NASDAQ 100 to get into bearish territory, it takes bear markets. It doesn't get down there without bear markets. Obviously, it had bull tags too, but that was way over here. Like, we're done with the bull tags. We are now in dark pink and pretty close to having a red line, which obviously would be a bear market there. Your Russell 2000 on this. Again, we also had 3 bull tags. The last bull tag was over here, dark light pink shading and a yellow line. And you can see, again, we are still below it. We are well below and have been below this. And we've had a few of these other global slowdowns impacted the Russell 2000 a lot more than the NASDAQ 100 did. and we are 10% below the moving average. Again, the expectation is that we are on our way into the first quarter of 2023. We are on our way into a protracted decline. In fact, I posted this tweet. I posted this tweet here. Let me bring it over so you can see it. Let me bring it over here. So here's this tweet. This is the fourth biggest decline this year that we've had. 1, 2, 3. All these other years, the S&P finished below the 200-week moving average by large amounts. This year, we actually finished above the 200-week moving average by almost 5%. So that, again, that goes to show this chart right here, just how far above the moving average we still are. And that's, for considering how bearish this year has been, to still be above the 200-week moving average. This goes to show how insanely bullish we were at the beginning of the year. And that goes unnoticed. We should not have been that bullish. The Fed should have put the brakes on way over here in March when we were already way too overextended. And because they didn't put the brakes on, the market was like, okay, here we go, and really went irrational and parabolic here into the beginning of this year. And again, and that shows and just how much we've declined this year, fourth biggest decline on record, and we're still above the 200-week moving average. Where the other three were like 20 to 30% below this dotted blue line at the end of that calendar year. And someone asked about rolling 12 months, same thing, right? This is the fifth biggest decline behind the 69.70 bear market. The fifth biggest decline. That year, we were also, that 12-month period, we were also 20% below the 200-week moving average at the time. So this is a unique period. And, again, the biggest moves, the biggest yearly declines occur below the 200-week moving average. So if we had a 20% move, almost 20% move to the downside above it, imagine what it's going to be below it. In fact, I did the numbers on the CAPE ratio, right? This long-term CAPE ratio here. Those other three times, by the time we got to the end of the calendar year, the highest that we were at was 22. What was the other? Let's see here. Where was the other moves? Let's see if I can find that tweet here. Give me 1 second. I can find it and bring it over. Here we are right here. So this one. I'll bring this over. So those other 2 years, you can see we were at, on the Shiller ratio, we were at 22.9 at the end of 2022, 9 at 74, and 15 in 2008. Well, if SPX were to get down to a 22.9, to basically 23 PE, then that means we're getting down to 3130 was the number. 3130 right there. That would get us to the 38% retracement of the long-term bull market, 62% retracement of the post-COVID rally, pretty much the pre-COVID highs. That's assuming earnings don't change, which obviously is not a good assumption because consensus is that earnings will drop, which means the market's got to drop even more. Again, just to get to 23, much less 15, which is where we were at the end of the 08 bear market, or the single digits like we got down to in 74 at the end of that bear market. Now, I don't think we're going to get down to single digits because interest rates aren't as high now as they were then. But can we get down to 15? Definitely. Can we get down to at least 23? Definitely. It's for a bear market to end at 28 is very naive for us to think that that's a normal thing, and for us to expect a really good bullish 2023 when that's all that PE has come down, right? Because the whole point of these corrections is to clear out excesses, clear out speculative greed, so the markets can be healthy again. If you're still at 28, we haven't cleared out the speculative greed. PEs are still really, really strong and really high. Basically it means that people have gone away from the ARK investment stocks of the world and moved into safer haven, safer stocks that have done really well, the Dow Jones type stocks. But they, again, it needs to be across the board for us to clear out this, the excesses and the speculation, the greed, before a good, healthy market, multi-year bull market can start up again. And so you would think that we're still a long ways away from that. Let's look at today's intraday move. Here, let's come to Now let's look at some of the other oscillators here really quick. So the DMI, we are above 30, above 25, excuse me, on the negative indicator. We are finally below 20. That's when the bullish trends start. We're below 20. So things are starting now to the downside on the S&P 500 according to the DMI. If you look at the RSI and the CCI, we're still in the lower halves of the charts, and we haven't really solidified the breakdown by getting below 40 yet, or getting really, significantly below minus 100. But definitely below 40 in the RSI. That hasn't occurred yet. So we still have some ways to go here. We're obviously still in a lower quartile, the 4-week range. The moving average is falling. We're still a little bit above the pace. I think it's because of the holidays. We're still a little above the pace of the last 3 legs lower to the downside. You can see them color-coded there. If you look at the Ichimoku cloud, we are in the cloud, right? Remember, we have to be above the cloud when it turns green. We have not been above the cloud when it turns green. We are in the cloud, and we have a weak bearish trend developing. It's still not, it hasn't strengthened, but it hasn't disappeared either. So we have a weak bearish trend developing, and you can see on the Bollinger Bands and the Keltner channels, we are not in the lowest quartile. The bandwidth is declining a little bit, but you can see the bands are outside the Keltner channels. You would expect that by the beginning of this next year, we'll work our way back down towards these Keltner channels and work our way a little bit lower, and you can see that as well. For example, on the hull, the daily hull, it's red, but we're above it. We haven't flipped that parabolic SAR over, but if you look at the weekly chart, then you can see, it hasn't even turned green yet, and we haven't flipped the parabolic SAR up, when we still have bearish candles. So you would expect that we'll probably get something on the bearish side of things, maybe as early as that first week in January. Let's look at the intraday move now, and you can see on the intraday basis, we ended up starting to fill in some of this gap. We filled in some of that gap too, and we haven't finished. Don't be surprised if we don't finish filling in that gap at the open. We do have a pretty big gap in volume there. That's something to keep an eye on. If we really start to take off in January, it'll start with filling in this gap here. So that's something to keep an eye on. Lots of strong volume going into the close, into the last day of the year. If you look at the trading range and the volumes, of course, they've been relatively, let's go right. Where is it? Right here. Relatively light volumes, not surprising because of the holidays, but it picked up at the end of the day today. It was a small range, well below average, 4 points, but 83 million shares trading hands. That's a pretty big number. It's, up into this area. Again, we are below that 2% mark, so we're not in the bearish mode anymore. Here, I have to zoom out now to give you context on this ATR to price ratio. 1% is the mark you have to get below for a bullish trend to develop. 2% is the mark that you get back above when you're on a new leg lower. So we haven't really even started according to that yet. And then if you look at the volatility, which we did a video, was the last Friday, I did a video on volatility, and on the market outlook, I did a pretty extended segment on that. So check that out if you haven't already. But if you look at the volatility and how we ended up closing the year, you can see we are compressing. It really compressed into the end of the year. And the volatility of the VIX closed at its, would this be the lowest level of the year? 77.05, 77.28. Over here was 77.11, 77.68. So yeah, so we finished the year with VVIX at its lowest point of the year. Again, think about it. So volatility of the VIX measures, again, the implied volatility of the VIX. So how much is expected to be volatile going forward. So it's really low. Now, but keep in mind, it basically tells you that the VIX has been compressing all year long. It's been compressing into smaller and smaller and smaller moves all year long. When I say that, if you had no idea what the S&P did this year, you would expect that we had a really good bullish year. Really, really good bullish year. For example, like 2000 and like 13 and 17, where other years that volatility really compressed down to low levels. And those were really good, strong, bullish years. Coming off of those lows in 18, we had really good bullish responses. So you look at this chart right here, you'd expect that we had a really good, strong, bullish year coming off of these levels. And this 2018, you had a spike. You had some bullishness. You had a spike in the fourth quarter, and then you came off of those lows, that volatile year, with a really good 2019. That wasn't the case. This is the fourth biggest decline in the S&P 500 in history, right? In its 500 stock in history. Fourth biggest decline that we've had. The other three were bear markets, and this one's been just a correction. The biggest correction probably we've seen. Again, correction being defined as that move between a move that breaks the 50-week and gets to the 200-week moving average. And during all that time, the VIX has been compressing, not expanding, right? With a washout move at the end of this correction, like we saw in 2018, fourth quarter. But the VIX has been compressing all year. There's been no washout move. So that just goes to tell me that 2023 has probably more volatility left to come than what we saw in 2022. All right, let's take a look now at what's driving the price action here today. And you can see over the last 3 months, one of the biggest drivers has been this decline in the dollar. Dollar's down 7. So we finished the year, pretty much the last quarter of the year, with the dollar down 7.75%. Yields were up for most of the quarter, a little dip there, but yields were pretty much up most of the quarter, with TLT down 4%. That put some pressure on the Qs, but did not put pressure on the rest of the market. You can see IWM and SPY were up for the quarter thanks to the weakening dollar. Commodities and gold really rallied sharply. Again, not necessarily a safe haven, not an inflation hedge, mainly just an alternative to paper money, right? When the dollar goes down, gold goes up, generally speaking. Now, they can both go up in a really significant risk aversion cycle, but in this case, we're not really, obviously, not in a significant risk aversion cycle. So bonds are down, the dollar's down, gold's the only one of those risk safe haven asset classes that's actually up. Again, mainly because of the significant drop in the dollar. I mean, that's a big drop. 7%, as you'll see here in a second, is a significant drop in the dollar. You can see EFA, the weakened dollar also really benefited international stocks. EEM was up 8.25%. EFA was up 16.78%. It's been a long time since we've had any kind of a significant outperformance in any kind of international equities over U.S. equities, and you can see pretty much all of November and December is where the outperformance came, and you can see that here on this chart as well. It's really from the beginning of November right here. Here is where emerging markets started to take off there. So here, go back to here. So I mean that's a nice good run off of some significant lows at the end of October. You can see the long-term PPO is rising there on the daily chart. Let's go to the weekly version of this, and then let's go out a few years for some context. And you can see again just how bearish international equities have been for years and years and years. And now you can see we are above the 8 and 17 week moving averages. They have both crossed above the 30, about to cross above the 50, and you can see the 30s turning up, and the long-term PPO, which has been negative, again, for years and years and years, is now turning higher too, with the strongest MACD that we've had since 2017, when we had a good stretch of outperformance by international equities. The CCI breaking up well into the upper half of the chart, and then solidifying that with a break above 200. And then you can see the RSI also breaking up above 60 for the first time since 2017. So this is a real significant regime shift on equities from U.S. equities to international equities this past quarter. Let's take a look at some other charts. Let's take a look at this chart. And let's first of all look at EFA, because that's been the biggest bullish mover. You can see pretty much all this outperformance has got us up to from what has been a bear market for international equity. We haven't been below the 200-week moving average in U.S. In the S&P at least, but we have been in the EFA for multiple months. So we have been in that bear market now on international equities, and you can see what we've done here over the last couple of months for this quarter is essentially got up to the 50-week moving average for the first time. Like once we dipped below it, we never made a return move, even to the 30 for that matter. And this is the first time we've had any kind of move back up to the 30 or 50-week moving averages. Considering the gap between the two, we filled in that gap. Now the question is whether or not we got up to the point of control, a little bit above it actually. Now the question is how long this will be sustained. And in my opinion, I don't think it will be sustained, but I do think that it won't drop as much now as what U.S. equities are in this stage, where they're just now assuming we do break, they just now are going to be breaking the 200-week moving average. And when you look at EEM, you see a similar pattern, except we didn't get to the 50, we got to the 30-week moving average. Again, for the first time since we broke the 50, have we made a return move up to that. I mean, we haven't even closed above the 17-week moving average this entire time until at the beginning of November. We had a couple really strong months in a row, like these Chinese stocks doing very well. But you can see losing momentum at the 30-week moving average with the MACD histogram already rolling over, again, on a weekly chart, mind you. So, and again, a lot of the strength has been because of the weakness in the dollar dropping all quarter long, all the way down to the 50-week moving average, after having been above, again, the 200-week moving average this entire year. And then finally, and never even testing the 17 really for most of the year. Like we never even got to the 17-week, but we blasted through the 17 all the way to the 30 there in that first weekend, second week in November. And then we just continued lower the rest of the time to the 50-week and into the value area, to the 38% retracement level of this rally we had off of those 2021 lows. And now potentially down to the 62% retracement of this current year-to-date rally that we've had, which is aligning with the 50% and which is aligning with the COVID peak in the dollar. So we'll see how much longer the dollar can last. The bonds have made a nice little run up from most of this quarter, but you can see they are working their way back down the last 2 weeks. Working their way back down below the 8-week moving average. The histogram is the stochastics and the MACD are both rolling over, and you can see what that's doing to yields. In particular, the 10-year yield over the last 2 weeks has gone from a close of 3.48% up to 3.87. So just like that, we are back up to relatively high levels. Again, when we hit this level over here in the first week in October, when we were rising up and we had a good run, and we got to pretty much close the week the same level we are right now, the first week in October. When you look at the S&P, the first week in October is right here. So we were down to the 200-week moving average. We're a lot lower than we are right now. So that kind of gives you an idea of how bearish we can be considering the move in yields, and you can see the rollover. The MACD is not crossed over yet, but the stochastics has crossed over its moving average. Obviously, we are below the 8 and 17 weeks. They are both down. The 8's below the 17. That's why the MACD is negative. The 8 and 17 are both below the 30. So if we can get a significant reversal back above 3,900 by next week, then we might be able to turn this ship around. But assuming that we are on a bearish rollover, and we get back on this pace, we're probably closer to 3,700 by the end of next week if we maintain the bearishness, which that's the direction I'm leaning. Obviously, it's not 100% probability of that happening, but I think we have higher odds of that happening than we do closing above 3,900. So that's bond. Let's look at one more, commodities, how they've been doing and how they finished the quarter. You can see they've been relatively sideways. They've been on a decline. The 8 and 7, the 8's below the 17. But you notice now for a good chunk of this time, the MACD has been kind of basing. The histogram based a long time ago, and now the MACD itself has based, and it's kind of forming a higher low with this semi-equal low point. Same thing with the stochastics, and they're turning higher. So it's looking like yields and commodities are both turning higher going into the beginning of 2023. That could be a function, considering the strength in emerging markets and especially China, that could be a function of the China reopening, which obviously with unemployment as low as it is could rear its ugly head. Inflation expectations could rear its ugly head again, just when it seemed like we were starting to kind of tamp it down at least here in the U.S. So, again, we are in a global marketplace, and we benefited this, past pretty much the second half of the year. We benefited from China being closed down, and that's helped bring inflation levels down. But now, with unemployment still low and China starting to reopen, obviously you've seen the last couple of weeks what that's done to commodities and yields, and that was a bad combination for U.S. equities in 2022, and you would expect that it would be a bad combination for equities going into 2023 as well. Let's take a look at the sector moves and how they finished the year. So let's come over here to the sectors, and you can see again for the quarter, this has been a cyclical quarter, but not the XLK, XLY, XLC, right? Which again is the biggest, 40% of the S&P. It's been XLE, B, I, and F, right? That's the other kind of, there's two different cyclical areas, and this is kind of the lagging cyclical area. These are the long duration. And again, yields being up has put pressure on those three. These are not necessarily the three sectors that, that can lead the markets high. They're lagging sectors, not leading sectors. So not necessarily, again, the sectors you would expect us to lead the way higher into a new market sentiment run to the upside. And in fact, it's, again, kind of similar story that, they are not, they are the sectors that, tend to do well at the end of a bullish run. In fact, you can see year to date here, going all the way from the beginning of the year, energy, industrials, financials, materials have been the outperformers. Now down negative on the year, but still outperformers pretty much this entire year. And XLK, Y, and C have been your significant laggards with the rise in yields for most of this year. S&P down that 19.44%. So energy up, 60. It's been a great year for energy. So real estate also struggling from the rise in yields as well. Utilities not, right? Utilities and staples and healthcare also with very small losses for the year to date, considering their safety trade aspects. That's not surprising. You'd expect real estate to be up there too, but again, real estate was just as overbought as equities were, and they're getting hammered along with these other long duration asset classes. Let's look at just this week alone and how they performed here just this week. You'll notice that it wasn't very much of it. Again, it was a kind of an up and down week. Financials and energy were your biggest winners. XLK, Y, and C were kind of matching the markets. And other areas were pretty, materials were down, staples were down, utilities were down. So not necessarily, you can see it early in the week, XLK, Y, and C were big losers going into Thursday. And then you can see Thursday and Friday how they kind of ramped back up, at least on Thursday, ramped back up before some more weakness on Friday. But this is your typical risk off here, aside from the strength in financials, so the first 2 days of the week, and then going forward from here, just how bearish we were. This is pretty much the reason why I did that video on Tuesday night with what we saw on Wednesday, and then the nice little recovery Thursday, and then you can see how we finished up and down, finished the week up and down here. Let's take a look at some of the bigger movers for this week. All right, let's take a look now at how these different individual stocks did in these sectors. You can see Apple and Tesla were kind of some big names. It had a rough week, but they finished the week pretty strong. Apple and Tesla did. And on the flip side, these Chinese stocks that did so well. You can see Baidu over here as well. These Chinese stocks that did so well earlier in the week gave up some of those gains by the end of the week. Taiwan Semiconductor as well, down 2%. Micron was down. So these chip stocks that had been struggling, here, let's pull some of these stocks up here. So we'll take a look at Micron. These chip stocks that have been struggling and had a little bit of a rebound on Thursday gave some of that back here today. And you can see Micron still, that it's trying to do this convergence. MACD is above its moving average. We're easily below the 17-day. But we're still pretty negative and below the point of control, 52-week lows. So not really doing as hot. Alibaba, which has been a a good reflection of how these Chinese stocks are doing, is also in a convergence mode, right? So they've had a good week, but they're pretty much avoiding a reversal, right? They've been above the 17-day moving average, but the MACD's been below its moving average this entire time. My expectation is at some point in time, some of this support will end up resistance, at the point of control and the 200-day moving average will end up holding in this convergence, and especially long convergences tend to lead eventually to a divergent move, especially with the stochastics in bearish territory there. So Home Depot is another stock, as you saw here in the Home Depot and Lowe's, McDonald's, and Starbucks were some more consumer discretionary stocks that had a rough go of it today. Let's take a look at some of those here. Let's take a look at Home Depot. You can see Home Depot had been also converging for a good period of time going into December expiration. But as I said, long convergence periods tend to turn into divergent periods, and you can see that end up happening. You came back below the moving average on the MACD, and you did break the 17-day, and it's been down below it ever since. The difference here is we are above the point of control, and we are above the 200-day moving average. They had a good run, and you take a look at the weekly version for this, you can see that long upper shadow, which is not a good sign. You are actually still above the 8-week moving average. So it looks like Home Depot is kind of just starting a little bit of a reversal pattern with two weeks of really significantly low volume. McDonald's, kind of looking very similar, just a little bit more bearish. And again, long upper shadow from a couple weeks ago has been really, really bullish. I mean, there's no way we're in a bearish market. We haven't even started to correct. McDonald's has tried to correct a few times this year, but it's just bounced right back up. In this case, got up to new highs earlier in this quarter, and you can see a little different story on the daily chart. So we are back. Well, we are below the 8 and 17-day moving averages. They are down, and so you wonder if we're going to get again, you typically get the MACD and the histogram kind of bottoming near each other, and you had a bottom on the MACD, but not with a negative MACD up here. And so at some point in time, I think we're going to get a surge in momentum to the downside. It's kind of similar over here, a surge in momentum to the downside with that, and that will probably push McDonald's down a little bit as it moves towards that and fills in that gap towards the 200-day moving average. Obviously, Tesla has been in the news for most of this week, as bearish as it's been, as bullish as the last 2 days have been for Tesla, especially yesterday, last 3 days really. You can see that you're basically just getting up to the 8-day moving average. You haven't even closed about it, and you have such a wide gap between the 8 and 17-day to fill, and a wide gap between the 17 and the 30 to fill, that you're probably not going to get a whole lot of bullish move on Tesla. You're probably going to have a little bit of a convergence period for a while, but with the ADX as high as it is, and the positive getting so high, the negative indicator getting so high, I don't think there's a lot of downside to Tesla here. I wouldn't say there's a lot of upside either. I think you're probably going to stay in some kind of convergence mode for a while on this stock as the MACD gets above its moving average, but we stay below the 17-day moving average for a period. So you'll probably get some kind of basing period here, at which point, at that point, we'll either make a new leg lower to the downside, or you will jump back up. My expectation is we'll get a convergence period probably back up towards 160, if that, right? You can see on the daily chart, getting to the 30-day is, right now getting the 30-day would be at 160, but you'd probably be in this area here as you converge for a little bit, maybe a little bit of a divergent period, something like this, before we roll back down to the downside on Tesla. So one of the strong areas of the markets today has been the energy sector. You can see lots of green up here, and Exxon, one of the bigger names in this spot. And if you take a look at Exxon, it had a nice little bounce. It's been bullish. This is the daily chart. This is the weekly chart. It's very strongly bullish here. But you can see on the daily chart, we had a pullback. We got below the 50-day moving average. But we have now been back in a divergent period back to the upside. And then with this little rally here, getting back up above the 50-day moving average, the 8s are back above the 17. They look like they're both close to crossing above. The stochastics is well into bullish territory. Again, it's hard to be too bullish on pretty much anything right now, considering the expectations, especially going in January. But one spot looks like we can be relatively bullish is in this energy space. So what I wanted to do here, you can see we already have a class trade on this and another class portfolio, and it's a long put vertical spread. But what I wanted to do here for this trade is do a bull put spread, so selling the 108 and buying the 106, doing again a $2 wide spread. We need to get at least 47 cents to get a 30% return on risk. You can see. Let me take off the trade here. We'll just do simulated trade. The bull put spread. So we can do a full position size on this. You can see going into January expiration, there's not very many days left. There's only 3 weeks. Earnings will come here right after January expiration. So we can do a full position size without having to worry about the earnings impact on this trade and getting a pretty decent return. You can see from my slices, if I put that slice onto the chart, here, let's put it onto this chart here. And just one more quick thing too about this. So we had a drop on XOM. So we had the spike up on the Rune indicator up to 100 on the negative. So you look for the green to get to 0. You look for the red to get below 70. It's gone all the way below 70 and below 30. In fact, they're both down below 30, which signals that we're going to get a significant change in direction. Last time we had that over here where they were both below 30, the change in direction was to the upside. And so that's my expectation again here, that with a big change in direction, with a really small range right now, we're going to get a pretty significant move one way or the other. And I expect, considering the Rune, that it will be a move to the upside. You can see the high is about to change. We're about to get a new 4-week high just in another couple of days, depending upon how we open the year. So we're going to get that green tag that jumped to 100 any day. The low, we're nowhere near the lows. So again, another reason to expect a jump to the upside here. And then our break even is back pretty much at the midpoint. So we'd have to break back into the midpoint, and that's going to change as the high comes down to this area. It's going to come down a little bit lower, but we essentially have to break into this gap, into the lower half of the chart, to really consider taking hopefully at most a $400 loss, because that's what we're trying to make on that trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a happy New Year, everybody. Have a great weekend, and we'll see everybody in 2023.